The dollar's breakout comes just 2 days before the Fed decision on interest rates. Wall Street's expecting to see the first rate cut since the financial crisis. It's a move that could shake up your portfolio. Let's bring in Savita Subramanian, the head of U.S. Equity and Quantitative Strategy for Bank of America Merrill Lynch. Savita, welcome. It's always great to see you in person.
It's great to be here.
So 25 basis points, that's pretty much baked in. So what do you think the market reaction is to something that's so widely anticipated?
I mean, I think if we don't get 25 basis points, the market will throw a tantrum. And if we get more than that, I think the market might freak out a little bit, because that means that things are actually worse than everybody thinks. So, I mean, I guess my best guess is we get 25 basis points. Beyond that, I suppose our view is that we continue to see the Fed backstop risk and do whatever it takes to sort of extend the cycle. I mean, it's a tough position to be in, because you don't want to be short equities when you've got the Fed saying, we're going to do whatever we can to extend this bull market, to extend this economic cycle. But then on the other hand, you've got trade, you've got kind of paralysis of the corporate sector. So I feel like it's a really tricky market right now. I mean, what I think is super interesting is that when we look at the buy side, so when we look at institutional managers, they are more correlated with one another than we've ever seen it. So one of the things that we wrote about last week was that the overlap between long-only mutual funds and hedge funds has reached peak levels. And I think this smacks of massive uncertainty, right? Like, I mean, there's always uncertainty in the market. Nobody knows what's going to happen tomorrow, let alone, next year. But right now, I think that uncertainty coupled with career risk is driving everybody into this same very narrow subset of stocks.
And that was a note that came out, specifically the line about career risk, a couple weeks ago from Bank of America Merrill Lynch.
Yes, exactly.
That really caught my eye. So when the Fed is creating this environment here where you know that it's going to be backstopping risk, does that further crowd these trades? It sort
of feels like it. I mean, basically what they're doing is they're extending the mantra that we've heard for, over 10 years now, which is that we're here for you. Central banks and policymakers are going to grease the wheels, keep the cycle going. We've had unprecedented monetary stimulus. Now we're starting to see fiscal stimulus. So I feel like it is essentially kind of forcing investors into this very narrow subset of stocks that do reasonably well in an environment of, zero interest rates, but not necessarily great economic growth, which is a weird environment. We haven't had this until
you just mentioned we're starting to get some fiscal stimulus, right?
Yes.
So we have the election coming up. Likely politicians are going to want to keep the economy going. How big is the fiscal stimulus, do you think, going to be coming, and in what sectors? Should I look at cyclicals versus defensive? How should I play that?
Yeah, so it seems like we're ripe for fiscal stimulus. Everybody wants it, bipartisan support. The problem is I don't think anyone agrees on how to fund it. Right, so you've got Republicans that want to cut taxes, and you've got Democrats that want to cut spending. And I think it's going to be a big question mark until we get closer to the elections. When we get through the primary and we know who the Democratic candidate is going to be, then we'll have a little bit clearer idea. But I mean, think about it. We could have passed a pretty sizable fiscal stimulus bill over the last however long, 8 years now, and we haven't because nobody can agree on how to fund it. So I worry that fiscal stimulus is all that really makes sense now. I mean, stuff in the U.S. is old. It's breaking down. You go to airports here, and I mean, they're terrible. But I don't know if we're going to ever get the politicians to agree on how to fund it. I think if we did see it, it would be great for industrials. It would be great for technology, for a lot of the more, unit volume sales plays that haven't worked for a very long time. The question is, are we actually going to get that? And we've been waiting for fiscal stimulus for a really long time.
So if I listen to something else I think you're worried about reading your note today is that you have these earnings revision ratios that look awful. You have these sales revision ratios that look awful. And basically everything everybody said about the second half of the year in terms of guidance looks like it's playing out. We're back to 2013 levels.
Yeah, I mean, I think part of that, though, is, and tell me if I'm wrong, but I feel like this always happens. So there's a couple of quarters, then management uses the rest of the year to guide down. Analysts are taking down numbers. Numbers for next year are way too high. Everybody knows it. I mean, how many investors actually think that the S&P is going to grow earnings at like 12% next year? Not a lot of people. So I think that we've already started to discount slower growth. And all that's happening now is that corporations are using this as an opportunity to guide down pretty aggressively because, they don't really have a reason to guide up. Now, I have to say I'm a lot more positive than it sounds like I am on the longer term prospects for stocks because I still think, the S&P 500 is relatively underowned. We still have a lot of investors piled into either bonds or bond-like stocks. So any sentiment measure we look at, any positioning measure we look at suggests that maybe there's 5 or 6 stocks that are super crowded, but the rest of the market doesn't have a ton of positioning risk. I just worry, though, that we're at a point where the kind of the growth that we're seeing is so unusual that it's really squeezing investors into a very narrow subset of stocks.
Right.
So my best advice to anyone would be to stay out of those stocks and find something else. There's a lot of other really cheap, high quality, cyclical areas of the market. The U.S. consumer is doing fine. There's lots of places to go besides FANG stocks, besides high growth, and besides defensives,
Right.
and those are the spots that we would recommend.
Savita, thank you.
Thank
Savita
you.
Subramanian.
Great to be here.
The fact that we the United States, they're even considering dollar intervention to me, again, is absolute madness. You have to ask yourself, what level of permanence, if any, would it have? And would the fact that we're doing it cause more harm than good? I say it would cause more harm than good. And, again, with the dollar here at levels we haven't seen, I think, in a few years-ish, gold market continues to hang in there. I think, again, I'll say, the gold market is trying to tell the market something. It's trying to tell the market that these central banks are out of control and that it wants to go higher. I still say, out of all the things we talked about, you stay in the gold miners.
All right. You own some of these crowded trades. Does that concern you?
Well, of course, I think, Google's not crazy expensive given the kind of quarter they just put up. So, and I'm not worried about short-term, trading around the market. So I'm staying in those.